So you're saying, like, if you had a portfolio of startups with failures included, you should expect a 50% return?
Well, if you want to look at a venture capital portfolio, they look for a 10 to 50%, 50 times return. In a venture capitalist, if they have 10 companies, how many do you think go to zero?
8, 9.
Well, about 3 to 4 or 5, actually they get zero out of them. How many get their money back? About 2. How many get a 2 or 3 times multiplier? 2. The ones that get 10 to 50 times are 1 or 2 in a portfolio of 10. And they pay for the whole thing. So that's the portfolio of a venture person, and that's the risk. So we're determining where you fit to use the present value.
And what does mature mean? Is mature size or is mature time?
Both. It's both. But so we build it up right here, okay? To get your discount rate, we're actually going to build it up based on your company.
Based on the specifics.
Yep, the specifics of your company.
So the size, the
Yep, the industry, the company specific, we're going to build it up. Does that make sense?
Okay, yeah, I got you.
Okay, cool. All right, now discounts. Remember, Linda?
Yes.
I was going to buy Linda's business in 5 years for $1 million, right? But I'd like to get to know you in Florida, and it's not bad. Orlando's here, you know, I can come bring my kids, have a good time at Disney World. So I'm going to get 10%. If I pay $100,000 to Linda today for my 10%, who wins in that deal? Why? Okay, so we're talking about minority discount, right? I live in Utah. I'm not here seeing your groups, whatever, so I own 10%. I have zero control, so I would have a discount, right? The range, there's lots of studies that show the range is from 14 to 40%. So let's take 25%. Now I'm going to offer Linda $75,000 because I'm taking a 25% discount for my minority. Who's still winning in this transaction? She's still winning. When do you sell privately held stock? When do you sell it? When somebody dies, or you want to pass it on to your heirs, or you want to sell the company, right? You don't call your broker and say, hey, I want to sell Medicomp today. And they're going, who's Medicomp? Right? So there's a discount for holding privately held shares because they're not liquid. You can't just go and dispose of them. The discount ranges from 10 to 50%. So I had 6 partners in Minneapolis, and 5 of them were buying out the one. So the one was diligent, went online, found 10 comparables of public companies. So he said, hey, this is what my value is. What's wrong with that? He's a privately held company. He's comparing to publicly held companies. There's a discount of between 20 and 50%. After we did the numbers, guess what the discount was? 40%. Okay? Yes?
You are drawing a distinction between valuation and price.
I'm coming to a price.
Okay.
But
Based on valuation. But
yes.
You're not saying valuation is the same thing as price.
No, not at the moment. All right. Does everybody understand the marketability discount for privately held companies?
Can you go through that distinction a little bit more? Because I would argue that that is what you come down to.
Okay, so I'm going to give you 9 values. The price is whatever a willing buyer and a willing seller are willing to accept. So how you negotiate with the 9 numbers is power and knowledge. So the price is whatever you negotiate. The value might have 9 numbers that are circulating in a pod, and that's to help you to get to the price. Does that make sense?
Yeah, because when you get the price, you'll start, we consolidate operations, there's other synergies, stuff like that. It has a higher value to the buyer than what it is on the paper.
So let's talk about synergies. Since you're bringing up synergies, if you're going to buy a company, you may consolidate admin or overhead. You may get some additional marketing or new distribution, right? So you could augment this line with the synergies that you're going to get from the business and then run the present value, and now you know what the synergies are worth. Make sense? Again, knowledge is power. All right. So I'm going to charge another 25% discount for marketability because she has a private practice, right? So now I'm at $57,500. Who wins in the deal? I'm going to buy 10% for $57.5. We're even at this point, right? Whoever negotiates the best, because I've taken into account minority, I've taken into account that it's a privately held company, so now I'll give you 50. Nah, she's not too excited about that. All right, we'll see what the willing buyer, willing seller are willing to negotiate, right? But you want to consider these things. Okay, now going back to weighting. I'm going to have 8 or 9 numbers. Everybody wants to get one number. So you'll see on the report, here's the value of your company, because you have to weight all these numbers. We're going to give you one number. I'm going to weight them based on what I think the reliability of the data is. But I want you to look past the one number and look at how that number comes about. Does that make sense? It's more powerful in your value to have a range and know what the range is. Yeah, we'll give you the one number. That may be the price you want to start negotiating with or something. But I want you to remember that knowledge is power and not just take the one number. Does that make sense? Yes?
So when you're talking about this, are you talking about fair market value, or are you talking about...
We are trying to determine the fair market value.
Or strategic? 'Cause it sounds like
No, the strategic value is adding in all the synergies, okay, and then doing a present value of the synergies, and that would give you your strategic value. Does that make sense? You know, I mean, if you know the synergies that somebody's going to get, I would say, okay, we'll share those. How about if I take 50% and you can have 50% of the synergies so that I get some credit of the synergies? Again, knowledge is power, right? If you don't ever mention the synergies, they're going to get them all. Make sense? Okay. All right. Here's an example. A company growing from $5 million to $13 million over 5 years. Their net benefit stream is $500,000 to $1.4 million. They go online and look up their discount factor, and they miss it by 10%. They make a $1.4 million error in a company that's doing $13 million, okay? If you miss it by 20%, they make a $3.8 million error. Now, remember that terminal value I was talking to you about? You forget the terminal value, it makes a $2 to $4 million error. You forget about this terminal value that's out here. Okay, now let's summarize. What are some common errors that I find in valuation practices? The discount factor is incorrect. They use the bank interest rate instead of their particular risk. They go online and pick an EBITDA multiplier and say, okay, that's what my company's worth. They use an unadjusted balance sheet for a value. Compare public companies to private and say, well, this is what I'm worth because this is what the public companies are worth. They don't look at the revenue multiplier and just look at an EBITDA multiplier. They use only the historical number instead of looking into what the future numbers might be, or the synergistic numbers for that much, okay? And they forget to discount for the situation, and they use no terminal value. Does that make sense? Does everybody understand some of the errors that happen? All right, now let's talk about how can you specifically increase the value with financially. Yes, sir.